Thank you, John Cole, CalPERS staff. Before I dive in and talk a little bit about it, I wanted to share with the committee the fact that I've had the opportunity over the last couple of weeks to be with stakeholder meetings where a chance to describe what we have talked about in public session, most recently in September, and also to have the opportunity to respond to questions and hear what's on people's minds. So what we hope to accomplish today is to fill in some of those questions to make sure we address what we think have been some misinterpretations or maybe lack of information that help us move along as a committee in your case and as a staff in thinking about an execution phase. So that's, I think, an important step. And what I want to do is to follow on with that with my remarks here. So I'd like to start by briefly reviewing what we set off to do 2 years ago, and that was to take an in-depth study and look at our strategic business model in private equity. 2 years ago, as you'll recall, we were completing our asset liability management process, the ALM process, where we look out over 10 years to forecast investment returns by asset class and determine our total fund strategic positioning for the next few years. As you know, today our required rate of return stands at, or to be, 7%, and in order to pay the promised benefits. And our funded ratio is approximately about 71%. Our ALM process resulted in forecasts by asset class where only one had a projected return greater than 7%. That was private equity. In CalPERS total fund, our private equity proportion has gone down over the past few years from a high of about 12% to now about 7.7%. That represents about $28 billion invested today, and that has been a result of committing at about a $5 billion per year rate over the past number of years. At our current path, we will continue to trend down as a percentage of the total fund. So at a time when we would like to have a growing presence, we have a diminishing one. The scale necessary to move back towards 10%, which would be our longer-term goal in the fund, translates into more than double our current commitment rate. Now, several questions arise. A lot has been written generally about how much capital is going into private equity and how high valuations are. And as Mahbub pointed out, both are true. To the first point, the overall private equity market is growing very quickly due to a number of factors, including, and we've touched on this I think at our offsite back in July, 18 months ago, more than 18 months ago. And that's that the number of public companies in the United States is one half what it was 20 years ago. And it's been a steady slide to get to that level, roughly 3,600 companies down from roughly 7,200 companies. And also, the number of companies that are private and have chosen to stay private has grown dramatically. And along with that, the size of companies that are private has also expanded dramatically. We've referred to the term unicorns. That's companies with a market capitalization greater than $1 billion. There are now hundreds, not only in the United States, but in China and elsewhere around the world. So the opportunities and the implications for particularly our innovation direct investment vehicle, which would be focused on the nexus of technology, life science, and healthcare, are very positive around those developments that have been occurring. As to the high valuations, we are very aware and reminded by experience. CalPERS in 2006 and 2007 chose to commit very large amounts of capital that was put to work just in front of the great financial crisis, and we suffered the consequences. Learning from that experience, it's our intention at this stage to be prepared for the inevitable end of this cycle. As Ms. Mahler pointed out early on, we don't know when, and we can't have confidence in predicting. But we do know that what it means is that we need to be ready to invest with a team in place, having established relationships and ready to take advantage of market disruptions. And if we're not there in advance, we'll be unable to do that. That all must be done in advance, and that's why now is an opportune moment to get ready. More as to why. We're seeking higher returns. We are willing to accept some higher risks, but in a very targeted fashion. So that consideration that Ted described that we've undertaken over the last 2 years has been very focused on identifying where risk makes sense for us, where we supplement our current access to the private equity market, and where combined we can create a larger amount of capital providing higher returns. We want to better align our interests with general partners who can, in this instance, and I'm now talking specifically about pillars 3 and 4, that is what we've referred to as our direct investing approach. General partners in these two areas would serve the mandate that we have determined. It would be very tightly defined, including incorporating processes around our values, our beliefs, our principles, and most importantly, the objectives that we want for the funds and their investing. A great contrast being in the traditional world where general partners where our relationships are primarily through commingled funds, which have dozens, literally dozens of limited partners, and a term that tends to result on a focus on the shorter term horizon, several years, as Ted noted. And therefore a playbook that often emphasizes the use of leverage and paying out dividends quickly and early, cutting cost, and often selling assets. Those are part of what comes with a shorter time horizon and have been present broadly in the private equity world. And there's an effective place for that. It makes companies better over time, but it is not the sole way to create value. In our Horizon entity for direct investing, by having no fixed term, no time when we put pressure to have to sell to realize the end of a contract period, we are incenting behavior that results in long-term value creation and promoting growth focusing on investing in the business, investing to maintain competitive advantage versus technology disruptors, and by expanding into new products and new geographies that over the long run create jobs, generate cash flows for long-term dividend, and build sustainable contributions to society and to their customers. With that as prologue, allow me to describe what we've learned. Over the past 2-year period, we've come to appreciate the need for evolution at CalPERS in order to address our need for large-scale investing, the need to anticipate the changes that we expect, in fact, believe are coming in the private equity business, and the need to put ourselves into a strong competitive position that takes advantages of our strengths and addresses some of our challenges as a large public organization. We come to this without a desired outcome except to build a structure and strategy that is durable, supported by the organization, and allowed to succeed. Here's how our thinking has evolved. The baseline is that today, most of our private equity assets are, again, as you know, in the large commingled funds. We have reduced the number of general partner relationships from several hundred to about 90 today and a target of about 40. We think that makes sense in order not to dilute our impact and as a result, the returns from the entire private equity portfolio. Virtually all that we now commit goes to this model, and as I mentioned, averages about $5 billion per year. We also have now and have had an emerging manager program in place for some time, over a decade, and which is a couple $100 million in size. And that's it. That's basically, simply stated, what exists. Prospectively, we've identified 4 pillars to a private equity strategy that would provide for an evolution and to increase the scale. First, to maintain an emerging manager program that promotes new blood and new thinking in the industry. Yes, the fees are higher, and we do pay a fund-of-funds advisor in order to work for us in the marketplace, but we can learn much and support this initiative in the investors of the future. And we think that's a worthwhile endeavor and pays long-term dividends to the portfolio, to the fund. This program will grow a bit, but still be a small part of the total portfolio. In fact, less than $500 million of the total. Next, Pillar 2 is the traditional general partner world of commingled funds, where we have a little negotiation leverage and even less control over the investments made and the governance employed. We've learned a lot here. A year ago, we thought maybe it would be best to find a large partner in a discretionary role to help us identify good funds and to expand our relationships to include more co-investing and access to secondary transactions. We found 6 outstanding organizations and issued an ASP, alternative solicitation. And those organizations who might serve in that role were outstanding and are outstanding. But we have come to the realization, after a lot of analysis and discussion, that the structure is unlikely to meaningfully strengthen our position. So as we complete our search, which will be in early 2019 for a permanent head of our private equity team, we will re-examine our options under Pillar 2 and consider whether an advisory role in order to supplement our own capabilities is more appropriate and will allow us to extend both our resource reach and our capacity best. That analysis will occur during the first half of 2019, and we'll be back to talk about that at the appropriate time. We expect to continue to access commingled funds for the foreseeable future, while adding co-investing to the mix, probably in a similar total range as today, roughly say $5 to $7 billion in commitments a year. Our third and fourth pillars are establishing independent, captive investment vehicles that have very specific purposes. And by captive, I simply mean that there is a single general partner and we participate as a single limited partner in that vehicle. They are importantly meant not to compete with our existing general partners, but in fact, might likely work together in some instances. And that's why the focus of and attention to what the mandate is so critical in building the supplement to our existing program. They together are referred to as CalPERS Direct, with a third pillar referenced as innovation, being an entity dedicated to late-stage venture capital at the nexus of life sciences, healthcare, and technology. We expect it to be a vehicle that will invest at a rate of $1 to $2 billion in commitments annually and grow to roughly $10 billion over a decade. The fourth pillar that we've referenced is referenced as Horizon, which will be focused on core economy companies that with durable business models, capable of attractive cash yields over time, with the opportunity to grow revenues by taking advantage of longer-term investments and a platform approach to building a portfolio. This vehicle we expect would invest in larger amounts and likely less frequently, and as a result, likewise, would be an entity that grows to also somewhere in the neighborhood of $10 billion over the course of the next decade. Both vehicles would employ an operations approach, meaning an active supplying of support to help our portfolio companies' investments grow and adapt. Both vehicles would be designed with no fixed term, thus not requiring a short-term payoff for returns or a necessity to sell at a specific point in time. They would operate independently of CalPERS with a clear definition of their mandate, routine interaction with senior CalPERS staff. I'm talking about the CIO, the COIO, the head of sustainability, and the head of private equity at a routine basis, and their own board of advisors, which would be focused on advising the management team about adherence to the CalPERS mandate, advising on succession planning so that we can keep these vehicles as perpetual entities if they work as we intend them to. Reviewing an appropriate operating budget to make sure that what would have been paid in management fees is paid simply in the amounts necessary to operate the business. And providing general counsel and advice on sourcing and other matters. We feel this buttresses the overall governance, and it reflects the types of partnerships that we've had over the past 20 years, and we've learned a great deal from, particularly in real estate portion of our portfolio. So in summary, the key to success of pillars 3 and 4 is to attract and retain very talented professionals, meaning to find philosophical alignment and to create competitive and compelling economic incentives. The combination of these 4 pillars will provide CalPERS the capacity to invest in scale and incrementally to the way and that we've grown our portfolio to date. The opportunity to take advantage of economies of scale. So as the assets under management and the vehicles grow, the rate in which we pay and therefore fees over the long run we would expect to go down, to diminish relatively. And a chance to create evergreen structures that incent private equity investing that doesn't just use the playbook that pulls out leverage and cost cutting, but focuses on long-term investments and growth. We get the chance to embed our values, our beliefs, our principles, and we distinguish ourselves in the marketplace as purveyors of patient, long-term capital investors. So that concludes my remarks and open for questions for the team.
Okay.